Free cash flow, or FCF, is one of the most closely watched indicators by company executives, investors, and other stakeholders. It is even the cornerstone of a cash culture, which is essential for your company's survival. So, what exactly is it? Free cash flow represents the cash flow generated by the company through its regular operations that is truly available. After paying for the investments necessary to maintain and grow the business, such as CAPEX, capital expenditures, and working capital requirements, WCR, free cash flow is therefore an amount of money that can be reinvested in the company or used to reward investors. One of the main advantages of free cash flow is that it allows you to very concretely determine whether the company is generating a positive cash flow or not. You might say that the income statement already exists for this purpose. That's true, but a company can have negative cash flows while still being profitable. And conversely, a company can have positive cash flows even while losing money. So, concretely, how do you go about it? Well, it's very simple. The first line of your cash flow statement is simply the last line of your income statement. From that, you subtract CAPEX, that is, investments. And then, if your working capital requirement WCR increases, you will subtract this increase in WCR. And conversely, if the WCR decreases, you will add this decrease. Indeed, an increase in WCR represents a cash outflow, whereas a decrease is a source of cash. Finally, you will add back, with the opposite sign, all depreciation, amortization, and provisions in English, non-cash items that you included in the income statement. The final sum gives you the free cash flow. So, to sum up, free cash flow is calculated by starting from net income after tax, adjusting for non-cash expenses, changes in working capital, and capital expenditures. Another variant is UFCF, or unlevered free cash flow, which in French translates to flux de trésorerie disponible sans effet de levier. This is the cash flow before taking interest payments into account. The calculation formula is as follows. REMIC, operating income, minus adjusted tax, plus depreciation and amortization, minus increase in working capital requirements, minus capital expenditures. With UFCF, removing the impact of financing decisions leads to more relevant comparisons between companies. You'll be able to compare apples to apples and oranges to oranges.